Hello, everyone. Welcome to this week's Fundamentals Unfiltered. I'm Matt with the Fundamental Investing Institute. We are recording this on Tuesday, November 18th, 2025. On this week's show, we're going to be discussing the Economist's 7 deadly sins of corporate exuberance. Why is the world seeing fewer recessions? What is labor hoarding? And what will Berkshire Hathaway look like when Buffett steps down? The Economist had a couple of articles this week on the risk of the global economy, and one of the articles that really caught my eye certainly deserves an A plus for creativity as well as content. It's called "The 7 Deadly Sins of Corporate Exuberance," and of course, using theological language kind of highlights their point. But as far as a summary of risk of corporate securities right now, this is a very good. It's a very good piece. So the first of their 7 deadly sins, lust for crypto. Of course, this is referring to Michael Saylor's Bitcoin treasury strategy that he kind of pioneered at a company that was called MicroStrategy. Now it's just called Strategy. And basically what he's doing is he's issuing a lot of equity and a lot of debt, using those funds to buy crypto assets, I guess specifically Bitcoin. And there are a lot of companies that are now mimicking this strategy. According to The Economist, over 100 companies are doing the same thing. And of course, there's been a huge pullback on Bitcoin prices in recent weeks. I think it's under 90,000. I don't really follow this market, but I think it's under 90,000, and this is something that's I think it's highlighting some of the risks that were taken earlier in the year. Now, there's a very famous short seller named Jim Chanos, and there was an article recently. He just unwound a short position that he had, and it was a very straightforward trade. He just shorted the shares of Strategy and bought Bitcoin in order to hedge it. But it sounded to me like it was a very profitable trade. There was an article that he had just unwound it. But so there are some people who are profiting from on the short side of this whole thing. But this is probably an area of risk that's going to continue, especially as more and more borrowed money is used to fund crypto purchases. The second of the deadly sins, according to The Economist, is retail envy. And basically what they mean by retail is retail investors, how more and more companies are courting retail investors. And of course, this is introducing kind of some volatility and momentum into the share prices. And it's also introducing, in a lot of cases, especially with a lot of the meme stocks, very unsustainably high valuations on these companies. Third sin, lazy circularity. This is something that's been dominating the news for months, of course, and I've talked about it. And it's basically the web of investments from a lot of these AI tech companies, where there's, NVIDIA, for example, is pumping money into some of the customers, and that money is in turn being used to fund NVIDIA chips. So you have this kind of intertangled web, and it is getting very complicated and very hard for investors to figure out where the risks are. Number 4, furious deal making. That's referring to the current M&A boom. And like every M&A boom, a lot of the buyout prices are very high. We're also seeing some deals are very heavily equity financed, but we're also seeing a lot of borrowed money come into this space as risk spreads on corporate debt is very low. Number 5, debt gluttony. Right, so this is the increasing use of debt, not only to fund that buyout boom that I just mentioned, but also to finance a lot of the AI investments. And that's an area where a lot of people are becoming very nervous because, frankly, if the AI boom cracks, it's going to have far bigger systemic implications if it hits the debt markets than if it hits stocks. Number 6 is patriotic pride. What they mean by that is there are a lot of companies, like JP Morgan came out recently and said that they're going to put $1.5 billion into national security related companies, but these are kind of vague. It's unclear whether these are companies that are just trying to get into the good graces of the administration or whether they actually see good investment opportunities. We have to see how this kind of plays out, but it does seem like it's more of a marketing tagline than anything. And then number 7, avaricious fraud. So this is something that I actually thought about recently. Is every boom that I've been through, there's an old saying that you don't know who's swimming naked until the tide goes out. And that's something that Warren Buffett said. And he said that specifically in relation to how much debt people were using. And the idea is that when you have exuberant periods and those periods subside, in other words, the bubble breaks, that you kind of see who's exposed. But the same thing could be said about fraud. Every boom that I've been through, when it's ended, you've seen a lot of fraud on the backside. Certainly Madoff would be the number one example. In terms of the housing bubble in that period. But go back to the late 90s, early 2000, and you had the big corporate scandals like Enron and WorldCom. So this is just something that is a natural feature of bubbles. And frankly, we don't know where or if fraud lies in the current exuberant, AI-driven assuming that it is a bubble, but no question as time goes on, you're going to see a lot of fraud reported on. And especially now, it's not clear that there's going to be a lot of prosecution of white-collar crimes. I don't know if that's necessarily a priority of this administration, so all the more reason to think that this is risky. But the interesting thing about this article is, as I said, as a summary of risks of corporate securities, it does a pretty good job and does so in a creative way. Now, another article that's in this same issue by The Economist, recessions have become ultra rare. That is storing up trouble. And basically the idea is that if you take away the pandemic and then you go back to the financial crisis, you had a 15-year period where you had some regional recessions, but you didn't really have a synchronized global recession. And what's happening in a lot of countries, including the United States, is you're seeing less of the kind of cyclical traditional recessions that you would have. So the U.S. is a good case because as we saw inflation jump up in the 21-22 period, and then we saw I wouldn't say overly tight, but you certainly had the Federal Reserve trying to catch up, and you had this big interest rate shock during this period. You didn't see the kind of recession that you would normally see with that kind of monetary tightening. And I think the reason is you had very heavy fiscal spending that was probably offsetting a lot of that. Now, that could be said of really all industrialized countries right now, but it's a very good point because the question is, if there is a very severe recession, all of this deficit spending means that these countries don't have the balance sheet strength that they had, especially in the United States. We had a very strong fiscal balance sheet going into the financial crisis in 2000 and 2008. I think the debt to GDP ratio was around 60%, which is, it's over 100% today. So a lot of these countries, including the U.S., just don't have the financial strength if we do see a very big recession. So that is one consequence. But another consequence is that traditional run-of-the-mill recessions tend to bring about what is called creative destruction. That term was coined by an economist named Joseph Schumpeter. And basically, creative destruction means a reallocation of labor and capital resources to more productive uses. So, when you have a recession, generally people will find new employment, very often better fits. Companies are forced to cut excess costs so they wouldn't otherwise, become leaner, become more competitive. And then, of course, a lot of people start businesses, so that's one of the very good things of a recession. And absent that, you could be seeing a lot of misallocation of labor and capital. But I think the biggest thing, it comes down to something that the investor named Howard Marks, one of the founders of a money management firm called Oak Tree Capital, and he writes these memos that have a wide following, and he's been given a lot of compliments from Warren Buffett. But Howard Marks has said in the past that what makes the system risky is the belief that there is no risk. So when you have a prolonged period of relatively rising asset prices and a relatively good economy, investors tend to get very complacent, and they tend to de-emphasize risk, and that itself leads to a buildup of risk. So that's one of the real consequences. Now, another article I came across, this one in Barron's, it's actually an op-ed piece, but it ties into this Economist article about the lack of recessions. This op-ed piece is called "Labor Hoarding Has Kept the Economy Alive. Is It Ending?" It's written by two executives at Fifth Third. One is an economist. The other, I think, is in the wealth management division. But they basically make the point that we've had a very weak labor market, and yet the unemployment rate is still very low. And that has been attributed by a lot of people to a supply issue. In other words, labor market participation, which is being driven very low by both the aggressive enforcement of immigration law, but also you have a lot of people that are just retiring. They're maybe retiring early, but labor force participation has come down, and so you really don't have the kind of supply and demand imbalances that you would normally see. But the other reason that these authors make is that you have what's called labor hoarding. Labor hoarding means that firms are hesitant to lay off workers out of fear that they will not be able to replace those workers on the other end of the cycle. And so this is a kind of a skills issue. And they make the point that this is one of the defining features of the current cycle, is that we've had a lot of firms are labor hoarding. And of course, it raises the question of what happens if that ends, right? Do we have an unemployment shock? I don't know, but it's interesting because it does seem to be a defining feature of the current economic climate. Now, the last thing I want to talk about is, I mentioned this on our last video about Warren Buffett had said that he's going quiet. So he's not going to be writing the shareholder letters, and he's not going to be doing the Q&A at the annual Berkshire Hathaway shareholder meeting. Barron's had this great piece over the weekend sort of speculating as to what Berkshire Hathaway is going to look like in the near term post-Buffett. And of course, Buffett is not, he's only stepping down as CEO. He's no longer going to be handling the communications. That role is going to be going to the new CEO, a man named Greg Abel, who has a very different background than Buffett. He's much more of an operator. But Buffett did say he's going to be coming into the office. He's going to remain chairman. And he's also, this is something that I think kind of satisfied investors over the last couple of weeks, is he said he's going to be holding on to his shares. He's, of course, pledged the overwhelming majority of his shares and net worth to charity, and specifically the Bill and Melinda Gates Foundation. But he said he's going to be holding on to those shares and therefore holding on to his shareholder vote while Abel transitions into the role. Greg Abel is 63, and as I said, he has more of an operating background. He was the head of their energy division, and I think in 2018 he became head of all of Berkshire Hathaway's non-insurance operating subsidiaries. And as the article makes very clear, I think as well, Abel's biggest challenge is going to be capital allocation. Berkshire Hathaway is sitting on about $350 billion of cash. They have a roughly $300 billion equity portfolio. And even Buffett has had a hard time putting that money to work. As the article makes clear, the last handful of big acquisitions that Berkshire Hathaway has done have been kind of hit or miss. Kraft Heinz, for example, is worth less than what Buffett paid. There have been a number of other acquisitions he's made that have been written down. And this is just a function of size. I mean, that much cash is really hard to put to work by anybody. And Berkshire does have two money managers. One is named Ted Weschler, and the other is Todd Combs, and they're managing about, I think they're managing about $30 billion collectively. And they'll probably continue to do so, but Abel is going to be responsible for the bulk of that cash. So what the article is speculating, and I think is a very good, I think is a very solid argument for this, is that what you're probably going to see as Abel comes into his own is some of that cash returned to shareholders in the form of dividends, share buybacks. And what you may also see is some divestment, whether through sales or spin-offs, of some of Berkshire Hathaway's smaller subsidiaries. So as Buffett himself has said, there's about 12 companies, 12 operating subsidiaries that really are doing most of the heavy lifting. Berkshire has a lot of smaller subsidiaries that are still profitable, but they're not really as important to the overall company as others. So there's a good chance that some of these smaller subsidiaries get sold off or divested, spun off. Spin-offs are always attractive because they can be structured without immediate tax consequence to the shareholders. They could be spun off, effectively on a tax-deferred basis. So, but that's probably what's going to happen when Abel really takes over. No one really knows. Another thing that the article speculated on is Abel may hold more frequent analyst meetings and things like that. Buffett is notorious. I mean, Buffett, just because of his sheer record and genius, has been given a lot of leeway by the markets. So he doesn't communicate nearly as much as other CEOs do, and Abel may have to be more of a conventional CEO in that regards. In any event, I think, as I mentioned last week, I have no intention of selling my shares in Berkshire Hathaway. I think it's a great company, will continue to be in the future, but it probably will be a little leaner. Now, as far as the cash hoard, I should say too, they have to keep a lot of cash on hand for their insurance subsidiaries because they have contingent claims they always have to reserve for. But other than that, $350 billion is a huge cash hoard that they're probably not going to be able to put to work in any meaningful way. Valuations are high. So you're probably going to see a lot of cash return to shareholders. Now, in keeping with that, I think I've been recommending some books, keeping with the theme of Warren Buffett. I think last week I mentioned The Intelligent Investor. If not last week, one of the previous videos, I mentioned The Intelligent Investor. I've mentioned Howard Marks' book called The Most Important Thing, which is very good. And then this is the book that many value investors will say is the book on value investing. This is a 7th edition called Security Analysis by Benjamin Graham and David Dodd. The history of this book is that in the early 1930s, Benjamin Graham, who was teaching at Columbia University, he was an adjunct professor at Columbia, and I think it was either a teaching assistant or grad student that was sitting in named David Dodd, who was taking notes on Graham's lectures, and those notes eventually became a book called Security Analysis, written in 1934. For many investors, that book has been through several editions, but for many value investors, probably the most definitive edition is the edition that came out. I think it was the 2nd edition, came out in 1940. So this edition, which is the 7th edition, Graham and Dodd have been deceased for many years. But what makes this a new edition is a number of very well-known names in the value investing community have made contributions, have written essays for the book that are attached to the 1940s edition. So they first started doing this in 2007. That was the 6th edition came out. It's edited by a man named Seth Klarman, who is a very well-known value investor. He runs the Bopos Group. and he was the lead editor, but he got together all of these big names in value investing. They put together all these essays. This particular edition came out, so the sixth edition came out in 2007. This particular edition came out in 2023. So it's much more reflective of current markets. And you'll hear a lot of investors just refer to Graham and Dodd. That is one of the editions of Security Analysis. And it's really kind of the canonical text of value investing, still very relevant today. And it's required reading. But of course, Buffett studied with Ben Graham at Columbia before eventually starting his own firm and then buying a controlling stake in a Berkshire Hathaway, and the rest, as they say, is history. But this is, it's more of a textbook, unlike The Intelligent Investor, which is written more for a general audience. This book is a little denser, but if there are any budding serious value investors out there, it's required reading. So with that, hope everyone has a great week. Happy investing. And as always, focus on the fundamentals.